Hi, I'm Hank Nicholson, President, Chief Investment Officer at SilverPeak Wealth. What I really wanted to talk about is not about COVID or about what we're doing around the office, but mainly I wanted to address something that is not being addressed on TV, and that is what's happening with your portfolio. And of course, I'm speaking directly to the clients of SilverPeak Wealth. So what have we been doing during this? So first of all, for the last couple of years, we've been telling clients we really want to get more defensive on our stock exposure. And for 2 years, we've been wrong. And the markets continued to chug higher. And now in the span of 2 weeks, we've been more right than of course, the wrong for the last 2 years. So, what did we do? What did we start putting in place a couple years ago? A couple years ago, we started allocating very strongly, or I should say, we started putting a lot more client money into a segment of the market, commercial real estate, and specifically non-traded REITs through companies like Blackstone and CIM Group. These are low volatility, high quality, high income producing real estate investments, large portfolios, high quality tenants that pay about a 5.5% dividend. Anyway, 5.5% dividend and a stable share price is, can be somewhat boring when the market's giving you 30% a year, but most of our clients went in that direction, and those non-traded REITs now are flat on the year, or even slightly higher. So that worked. Our clients got to earn that dividend, got to participate in commercial real estate, and didn't get, or at least not yet, haven't been hurt. Now, some clients are worried, well, everything's falling apart, real estate's sure to fall apart too. I don't know exactly. What I do know is that these particular funds are diversified across tenant. They have large corporate tenants. They're diversified across tenant, across region, across industry. So even if let's say their largest corporate tenant, Valvoline, which is 5% of the portfolio in CIM, goes belly up. Well, Valvoline is required to meet their lease payments before they even pay their bondholders or their shareholders. So, even if things get really bad, real estate, commercial real estate, especially this kind of high quality real estate, not speculative, not development, leases in place, 98% occupancy, 11-year average lease term. This is high quality income that doesn't deviate month to month. Now, obviously everything's at risk, but we continue to like this, and we're really happy that our clients decided to diversify away from stocks and get into that. So we've been doing that for 2 years, and clients were wondering maybe why they weren't keeping up with the market, and maybe that's why. So so now, things are different. So our clients weren't nearly as exposed to the market, but they were certainly exposed. So clients are worried. Things have changed. What's going on? Is it time to, protect capital, to sell, to, what now? So, a couple things. The what now I'm going to get to in a second, but I'm going to continue on the chronology of what are we doing? So 2 years ago, get more defensive, own real estate, own dividend stocks. Okay. 6 months ago, let's get even more defensive, but this time in our bond holdings. Let's cut back on high yield and corporate debt. Instead, let's focus on treasuries, high quality U.S. treasuries. They hardly pay more than a CD, but the bond yields are low, and just you getting an extra 0.5% to own something that has a lot of risk doesn't make sense. Let's just take our medicine, accept a low yield, own treasuries. We know they're safe. We know that we're at the end of a business cycle. We know like I said, the spreads between like what you get for a treasury and what you get for a corporate or a high yield are really not enough to justify the risk. So 6 months ago, we moved towards treasuries. good move. So in a panic like this, there's always a flight to quality. Investors will head towards treasuries, the biggest, most liquid, safest market in the world. So everybody wants to own a treasury. Of course, luckily our clients did own treasuries, but the prices spike up and the yields drop way down. So 2 weeks ago, so this was at the very, very start of this. This would have been today's the 20th. Yes, the 20th. So Friday the 20th, the 7th. It was a Monday. Anyway, sold the treasuries. They went through the roof. We took profits. We said that's it. They can't, or at least we don't expect them to be able to go any higher and to make our clients any more money. Let's just sell it and go to cash. That's what we did. That 2 weeks ago was the peak of the treasury market. Our clients got out and went to cash, and since then the treasuries prices have been coming back down. So, okay, 2 weeks ago we took our profits in treasuries. We went to cash. Okay, fast forward to today and what we're going to start doing. And I say today, yesterday, the day before. We've started to implement this, and we will continue to as we can. These are volatile times, and there's a lot of things that have changed, and we need to talk to a lot of clients and reassess and make sure that we're all on the same page. But what we're starting to do now is we're going to continue to be defensive. We still very much like real estate. We want our clients to both understand that yes, this is really serious, and this is a moment in time, and we don't know what the future's going to be like, but this too will pass. And investors are getting tired and worn out, and a lot of times they just want to give up. They just want the pain to be over, and it's really our job to say, well, yeah, we want the pain to go away too, but we know that it will, and so what we need to do now is actually think about what we wish we would have been thinking about in 6 months, meaning where are the opportunities? What are we supposed to be looking at? Well, I still feel really good about real estate. Like I said, interest rates are down. That means cap rates can also come down, bringing property values up. Yes, there's going to be more working from home. I still think, if we're going to learn something, it's going to be how valuable face-to-face community, team-oriented activities are. So I don't think commercial real estate, places where people gather to collaborate, are going to go away. So I feel good about that. The other places where we're seeing real opportunities, energy stocks and financials. Oil prices have fallen, have completely cratered. They're down, I don't even know what the percentage is, but it's well over half. ExxonMobil now trades at a lower price than it did in 2003. So so there's some real opportunities there. We're kind of dipping our toe in there, but we still want to remain really defensive. We're focused on income, dividends, and safety. So we're looking at those the same with financials, dividends, income, safety. Those have also been battered, and they're looking attractive. In terms of our bond portfolios, we know that there's opportunity right now in high yield and corporate. They've been sold off. Their prices are way down. We're not jumping in just yet. We want to stick with short-term treasuries. We really don't look at the bond side of the portfolio as the place to place bets. It's the place to make sure the money's there. And so we're looking at short-term treasuries until we can get a sense of really where the mispricings are in the bond market. So that's what we're doing. We're going to remain defensive. We're going to focus on income. We're going to focus on safe treasury bonds for the next several months. We're going to start rebalancing client portfolios, and to be real clear what that means, this is a discipline that we have our clients sign up for, and something that we feel like is probably the biggest value we can bring in volatile times like this. Well, second biggest. First biggest value we can bring is perspective and advice and knowledge of you and your situation. That's number one. But number two is the actual discipline that we bring around portfolios. So let's say that you're a client, and this might be you, of SilverPeak Wealth, and you have a third of your portfolio in bonds and a third in stocks and a third in real estate. Okay, well, the market just collapsed, and now that third that you had in stocks, that third is now shrunk to 25%. Well, your portfolio, you meant to have 33% of your portfolio in the stock market, and now you only have 25%. On the one hand, you could say, well, that sounds great because stocks are terrible. But I think the more strategic and timely way of thinking of that is, well, now's the time to actually rebalance. Let's take some profits, take some money, take a percentage, take 3% from bonds, buy stocks. Take some from real estate, buy stocks. Get back to a third, a third, a third, because that's actually the balance that we decided was your best long-term balance through the ups and downs, through the crazy markets. Let's keep sticking to this allocation because we feel like, based on everything we know, it's the very best for you. And that doesn't change when the markets go crazy. In fact, it's all the more reason to focus back on that and know that the reason we rebalance is to take advantage of mispricing in the market. We do not rebalance to time the market. Quite the opposite. It's usually not a pleasant experience rebalancing because we're usually buying what's terrible and selling what's great, and that never makes sense. But it's always the right thing to do. So we hope that you'll reach out to us. We hope that you'll schedule a video call with us. We'll reevaluate portfolios. We're going through everything. We're coming through markets, trying to see where the opportunities and the risks are in this new normal, and it will be a new normal. So thank you for your continued trust. Thank you for the business, and we appreciate you, and we appreciate giving the opportunity to help you out through these turbulent times. Thanks a lot, and best of luck through the virus. And let's talk soon.